A strange and surprising picture is emerging in the United Kingdom's economy. On one hand, there is a cause for celebration. The London Stock Exchange's main index, the FTSE 100, has climbed to a new all-time high. This suggests confidence and strength among the UK's largest listed companies. Yet, at the very same moment, a starkly different story is unfolding on the factory floors across the country. The latest figures show that manufacturing orders have suffered their most severe collapse since the depths of 2020. This is the central contradiction we must unpack. How can the stock market be booming while a vital part of the real economy appears to be in freefall? It is a puzzle that reveals deep truths about the structure of the modern British economy. This sharp contrast is not just a statistical quirk. It is a signal of a deepening divide. The headline number of the FTSE 100, often used as a simple barometer for the nation's economic health, is telling only one part of the story. It is a story of global giants, commodity markets, and international finance. The other story, told through the falling orders at manufacturing firms, speaks of a different reality. It is a reality shaped by consumer demand here at home, the health of our trading partners, and the real-world impact of rising interest rates. Understanding why these two narratives can coexist is crucial for anyone trying to make sense of where the UK economy truly stands today. On October 24, 2025, the situation presents a complex challenge for investors, workers, policymakers alike. For investors, the record high might seem like a straightforward sign to continue buying shares. For factory workers, however, the news of plummeting orders brings a sense of unease and job insecurity. For the government and the Bank of England, it creates a policy dilemma. Do they react to the strength in financial markets or the weakness in industrial activity? The answer is not simple, because both signals are real. They reflect two different economies operating under the same national flag, each responding to very different forces. In this essay, we will dissect this economic paradox. We will explore the specific factors that have propelled the stock market to its record-breaking peak. We will then turn our attention to the factory gates, examining the reasons behind the dramatic slump in manufacturing orders. By holding these two contrasting trends up to the light, we can begin to understand the underlying mechanics of the UK economy. We will see how the composition of the stock market, the swings in currency values, and the divergent impacts of inflation can create a scenario where the fortunes of big finance, big industry head in opposite directions, at least for a while. This sharp contrast is, worth digging into. To understand the FTSE 100's remarkable climb, we must first look closely at what the index is actually made of. It is not a perfect mirror of the entire UK economy. Instead, it is a collection of the 100 largest companies listed on the London Stock Exchange. Crucially, this index is heavily weighted towards a few specific sectors. Among the most dominant are the giant energy companies: Shell, BP. They are global titans in the oil and gas industry. Their financial performance has an enormous influence on the FTSE 100. When these energy giants do well, they can pull the entire market up with them, even if other sectors are struggling. Recently, these energy firms have reported exceptionally strong profits. The main driver is global energy prices, heightened geopolitical tension, supply chain disruptions, increased demand from recovering economies. All can push oil and natural gas prices much higher. When that happens, revenues and profit margins swell dramatically. Investors spot those soaring earnings and rush to buy shares. That demand pushes energy stock prices up. Since they're a large slice of the FTSE, the whole index is lifted. This is exactly the dynamic we've seen. Households, businesses, both have grappled with high energy bills, while energy producers have reaped record rewards. That flow of money into energy stocks has been a primary engine of the market's ascent to its new peak. It's a clear example of how global commodity cycles can move London's stock market. The FTSE's fortunes are tied not just to the health of the UK, but to the price of a barrel of oil in global markets. That global exposure helps explain why the index can seem detached from domestic economic realities. Investors aren't only chasing profits, they're also seeking reliable income via dividends. The large, established FTSE 100 companies, especially in energy and mining, have long histories of paying substantial dividends to shareholders. With government bonds less attractive, steady dividend income from blue chips becomes very compelling. Another critical factor contributing to the FTSE 100's record high is the performance of the British pound. It might seem counterintuitive, but a weaker pound can be very good news for the UK's biggest companies. This is because the members of the FTSE 100 are overwhelmingly global in their operations. A vast proportion of their total earnings is generated in foreign currencies, often estimated at over 75%. US dollar, the euro, and others. When these companies bring profits back to the UK, those foreign earnings must be translated into pounds sterling. Here is how the currency effect works in practice. Imagine a large British oil company selling in dollars. If the pound weakens against the dollar, from £1 buying $1.30 to £1 buying $1.20, every dollar of overseas profit is suddenly worth more in pounds. A profit of $1.2 million, which was previously worth £923,000, is now worth a full £1 million. This accounting effect provides an instant boost to the company's reported profits, all without selling a single extra product. This makes the company look more profitable on paper, which in turn makes its shares more attractive to investors. This phenomenon explains why there is often an inverse relationship between the value of the pound and the performance of the FTSE 100. When international investors become less confident about the UK's economic outlook, they may sell the pound, causing its value to fall. But that very fall in the currency makes the shares of the UK's big dollar-earning companies a more attractive investment. This creates a cushion for the stock market, allowing it to rise even when the underlying domestic economy is facing headwinds. It is a strange paradox where bad news for the UK can sometimes translate into good news for its largest listed firms. They are not just British firms, they are multinational corporations that happen to be headquartered and listed in London. Customer base is global. Supply chains are global. Revenue streams are global. Their share prices are often more sensitive to global economic trends, commodity prices, currency fluctuations. The FTSE 100 is less a measure of UK PLC and more a measure of global PLC with a London address. This fundamental characteristic is key to understanding why its performance can diverge so dramatically from domestic indicators. Now we turn to the other side of our economic story, the sharp and worrying decline in UK manufacturing. While stock market traders were cheering record highs, factory managers were looking at thinning order books. The latest data from manufacturing surveys, such as the widely watched Purchasing Managers Index, has painted a bleak picture. It showed that the volume of new orders received by factories has fallen at its fastest rate since the economic paralysis of early 2020. An order book is a forward-looking indicator. It tells us not what a factory is producing today, but what it is scheduled to produce in the coming weeks and months. A collapse in orders is a powerful warning sign of a slowdown ahead. This slump in new business is not confined to one or two niche areas of manufacturing. It is a broad-based decline affecting a wide range of industries. From car parts, construction materials, consumer goods, machinery, the signal is consistent. Demand is evaporating. When orders dry up, factories have less work to do. This inevitably leads to a reduction in production levels. If the trend continues, it can force companies to take more drastic measures, reducing staff hours, freezing hiring, or even making redundancies. The fall in orders is the first domino to fall in a chain reaction that can have a significant impact on employment and local economies. For the people who work in these industries, this is not an abstract economic concept. It is a direct threat to their livelihoods. the manufacturing sector remains a significant employer in many parts of the UK, particularly in the Midlands, the north of England. These are often skilled, well-paid jobs that form the backbone of local communities. When a major factory in a town slows down, the economic pain ripples outwards. Local suppliers see their own orders fall. Shops, pubs, cafes see less spending from workers who are worried about their future. The factory slowdown is a real-world problem with immediate human consequences. The severity of the drop, being the worst since the pandemic began, underscores the gravity of the situation. The 2020 decline was caused by a unique and unprecedented global shutdown. The fact that we are seeing a similar rate of decline now, in the absence of lockdowns, suggests that the economic forces currently at play are exceptionally powerful. It indicates a fundamental weakness in demand that has taken hold swiftly and deeply. This is not a minor blip in the data. It is a clear and loud alarm bell ringing for a crucial sector of the British economy, signaling a tough winter ahead for many industrial firms. So, what is causing this sudden freeze in demand for manufactured goods? The reasons are twofold: a cooling global economy and a tightening squeeze on spending here at home. The UK's manufacturing sector is highly dependent on exports. A big portion of factory output is sold abroad: Europe, North America. Many key trading partners are experiencing slowdowns. Growth has stalled in parts of the Eurozone. Other major economies are battling inflation. Weaker activity abroad means fewer imports bought. Domestic demand has been severely curtailed by high inflation and rising interest rates. Households have seen purchasing power hit by rapid price rises. People are cutting discretionary spending, new cars, furniture, home improvements. Instead, households prioritize essentials, food, energy. That squeeze shows up as fewer sales and orders. The Bank of England's rate rises, add another layer of pressure. Higher interest rates make borrowing more expensive for consumers, and for businesses, for individuals, that means pricier mortgages and loans, rising mortgage notices. For businesses, higher borrowing costs deter investment in machinery, expansion, new facilities. That decline in business investment hits makers of capital goods, industrial equipment, construction materials. The medicine for inflation is chilling economic activity. Weak foreign demand and squeezed domestic spending create a perfect storm for UK manufacturers. They're being hit from all sides. Export markets are shrinking, their home market is contracting. Unlike FTSE 100 energy giants who can profit from high commodity prices, manufacturers are caught in the middle. They face rising costs for raw materials, energy, but they can't pass those costs on to customers under financial pressure. Tight margins plus falling orders create a deeply challenging environment. It's a tough time. We have now established the two opposing trends, a booming stock market and a slumping manufacturing sector. The key to reconciling this apparent contradiction lies in understanding that the FTSE 100 and the UK's manufacturing base are, in many ways, two separate economies. They operate on different scales, respond to different incentives, and are exposed to different risks. The FTSE 100 is predominantly an index of massive global corporations. Their performance is dictated by world commodity prices, international market sentiment, and movements in major currencies like the dollar. They are financialized entities whose share prices reflect global, not just local, conditions. In stark contrast, the UK manufacturing sector, while containing some large exporters, is also composed of thousands of small and medium-sized enterprises. These firms are often more deeply embedded in the domestic economy. They rely on local supply chains, serve local customers, and employ local people. Their health is therefore much more closely tied to the spending power of UK households and the investment decisions of other UK businesses. They feel the direct impact of a rise in domestic interest rates or a fall in consumer confidence much more acutely than a multinational oil company whose profits are determined in Houston or Riyadh. This fundamental difference in composition is the primary reason why the two can move in opposite directions. The energy and mining stocks that have powered the FTSE's rally benefit from high global inflation because it drives up the prices of the commodities they sell. For a manufacturer, however, that same inflation is a major headache. It means higher costs for energy, raw materials, transport. This difference in how inflation affects various sectors is a crucial fault line running through the economy. What is a source of record profit for one company is a source of existential threat for another. Ultimately, the stock market and the real economy operate on different timelines and measure different things. The stock market is a forward-looking machine that tries to price in future profits, often months or even years in advance. The rise in the FTSE reflects a bet by investors that the big global companies will continue to be highly profitable. Manufacturing orders, on the other hand, are a measure of current real-world activity. They reflect the decisions being made today by businesses and consumers. It is therefore entirely possible for investors to be optimistic about the long-term future of global giants, while factory managers are pessimistic about their order books for the next quarter. That contrast is really at the heart of this story. The psychology of the investor and the reality of the factory manager are worlds apart, and this difference helps explain the current economic divide. An investor sitting in the City of London looks at a screen of numbers. They see rising profits for energy firms and calculate that share prices are likely to go up. They see a weak pound and recognize that this will inflate the sterling value of overseas earnings. Their decision to buy is a rational response to a specific set of financial data. They are playing a game on a global chessboard where the pieces are share prices, dividend yields. The health of a factory in Sheffield or Sunderland may not be a primary factor in their immediate calculation. The factory manager, on the other hand, lives in a world of physical things and immediate pressures. They look at the flow of new orders coming in, or in this case, not coming in. They have to manage production schedules, order raw materials, manage their workforce. A decline in orders is not an abstract data point. It is a concrete problem that requires an immediate response. Do they cut production shifts? Do they delay a planned investment in new equipment? Do they let go of temporary staff? These are difficult, real-world decisions that affect people's lives and the health of their business directly. This divergence is amplified by the different time horizons involved. Financial markets are famously forward-looking, but their focus can also be incredibly short-term, driven by quarterly earnings reports and momentum trading. The current FTSE high is a snapshot of sentiment today, based on expectations about profits in the coming months. A factory, however, operates on a longer and more cyclical timeline. The decision to build a new production line or hire and train new engineers is based on confidence about demand over the next several years, not just the next quarter. The current slump in orders undermines that long-term confidence, even as the market celebrates a short-term peak. Therefore, the record-breaking FTSE 100 tells us more about investor sentiment towards a specific group of global companies than it does about the underlying health of the wider British economy. It shows that there is money to be made in global energy and in companies that benefit from a weak pound. The falling factory orders, however, tell us a story about a lack of confidence and purchasing power in the real economy, both at home and abroad. Both stories are true. The city's optimism and the factory's pessimism can coexist because they are looking at and are affected by two very different sets of economic realities. Both can be right at the same time. This split-screen economy has profound implications for ordinary people and for those in government. For the millions of workers employed in the manufacturing sector and its vast supply chain, the news of collapsing orders is a direct cause for concern. It signals a period of uncertainty, with the potential for reduced hours, frozen wages, and job losses. This creates anxiety for families and can lead to reduced spending, which further dampens economic activity in local communities that are heavily reliant on industrial employment. The wealth being generated by rising share prices rarely trickles down quickly or directly enough to offset the immediate pain of a factory slowdown. Conversely, for the portion of the population that owns shares directly or through pension funds, The FTSE's record high is welcome news. It boosts the value of their savings and retirement pots, creating a positive wealth effect that might make them feel more financially secure. However, share ownership in the UK is highly concentrated among wealthier households. This means the benefits of a stock market boom are not evenly distributed across society. The current situation risks exacerbating inequality, with asset owners becoming wealthier while those who rely on a wage from the real economy face growing insecurity. This creates social as well as economic tension. For policymakers, particularly the government and the Bank of England, this divergence creates a significant headache. Do they set policy based on the booming financial markets or the struggling industrial sector? Raising interest rates further to bear down on any remaining inflation could strengthen the pound and hurt the FTSE 100, but it would also inflict more pain on manufacturers and mortgage holders. On the other hand, cutting rates or providing stimulus to help factories could risk reigniting inflation and be seen as irresponsible by international financial markets. They are caught between a rock and a hard place, trying to navigate a path that doesn't destabilize one part of the economy while trying to save another. The clear message for the government is that a one-size-fits-all economic policy is unlikely to work. A more targeted approach is needed. This could involve specific support for energy-intensive industries that are struggling with high costs, or investment incentives to help manufacturing firms modernize and improve productivity for the long term. It also highlights the need for policymakers to communicate clearly with the public, explaining that a headline stock market figure is not the sole measure of economic success. In conclusion, the United Kingdom is showing two very different economic faces. One is the smiling face of the FTSE 100, buoyed to a record high, fueled by huge profits at global energy companies, and the favourable arithmetic of a weak pound. The other is the worried face of the nation's manufacturers. They're seeing the sharpest drop in new orders since the pandemic. Domestic demand is weakening. Global demand is weakening. Both of these facts are true. They're not a contradiction, but a reflection of a disconnected economy. The stock market is not the economy, and the economy is not the stock market. The key takeaway is, look beyond the headline index number. For policymakers, the challenge is to craft a response that acknowledges this duality. Supporting the real economy, particularly manufacturing that provides widespread employment, must be a priority. That means creating a stable environment for investment and finding targeted ways to alleviate pressures on firms and workers without derailing the fight against inflation. Relying on the feel-good factor from a rising stock market isn't sustainable if the real economy's foundations are crumbling. A strong nation needs both successful global corporations and a thriving domestic industrial base. Ultimately, the true test of the UK's economic health will not be found in daily stock market fluctuations. It will be measured in the stability of people's jobs, the purchasing power of their wages, and the confidence of businesses to invest for the future. The current divergence between the FTSE and the factory floor is a powerful reminder. While investors may celebrate the new market peak, sustained prosperity will only be secured when British factories' order books are full again, signalling a recovery that's felt not just in the City of London, but in every town and community across the country. So, basically, targeted measures and clear explanation are essential. Look beyond the headlines. The FTSE can soar even as factories struggle, and both truths matter for the UK's future.